can you? Ah, there you go, you're back, Mohammed. Hi. So, well, firstly, just to say, Mohammed, thank you for inviting me. Thank you for organising, creating this series of talks. You know, sort of taking advantage of the pandemic to bring the global research community together. I think it's a wonderful initiative. So thank you for that. And my topic today is the relationship between financial reporting and sustainability reporting, and how these two domains can be brought together. This obviously is very topical. It's also, I think, widely misunderstood. So the financial reporting community on the whole has a limited understanding of what sustainability is and what sustainable reporting might look like and what it ought to look like and so on. And meanwhile, on the other side, the sustainability reporting community, generally speaking, is grounded in concern with environmental and social impact as an end in itself, rather than integration with financial accounting and financial reporting. So the overlap between these two domains is not well understood, I don't think. It's very important, increasingly important, that it becomes well understood. So what I'd like to do is just give an overview of this space as I understand it. This is going to be based loosely on a working paper, and I'll reference the working paper later. I say loosely because I'm not going to go through, it's a normative paper, by the way, it's not an empirical paper. I'm not going to go through the paper section by section, as it were, but rather draw insights and overall conceptual framing from it, which I hope will be helpful. And you know, please, I'm very happy to sort of stop and take comments as I go through, or we can take questions at the end. Either way is fine. So here's a very recent and very topical example of what I would describe as the misunderstanding in this space, and an example which is important. So this is a response written in not on behalf of the SEC, but nevertheless written from an SEC commissioner or an SEC letterhead. It's a response to the IFRS Foundation consultation on sustainability reporting. I've just taken an extract from a fairly lengthy, very well drafted comment letter. So, sustainability standards are unlikely to foster the same degree of accuracy, comparability, objectivity, and reliability as financial reporting standards. Although sustainability standards may touch on economics, they are not fundamentally about economic decision making. So notice there are some very strong priors in that statement, two in particular. One, that sustainability standards cannot be as accurate, comparable, objective, reliable as financial reporting standards. So there is something inherently flaky about sustainability reporting. The second presumption is that sustainability reporting is not really for investors. It's not really about economic decision making. It's about, I don't know, doing good in the world or something, almost in conflict with capital market decision making. The overall tenor of this letter is, dear IFRS Foundation, stop doing this. You're undermining your mission to provide useful information to capital markets. So it's very topical. It's a very strong statement. And it's, I think, an important statement to challenge, because I think it's a fundamentally incorrect statement. And I'll try to explain why I think that's the case. So this is a confused domain, right? Broadly speaking, the area of whether you think of it as sustainability or ESG or CSR or impact or stakeholder capitalism or whatever you want, whatever you choose to call it. It's an interdisciplinary, overlapping, multiple objective, unclear quite who the stakeholders are kind of domain. And not surprisingly, it's one that is confused both in principle and in practice. And that general sense of confusion is shared in some sense in the practice of corporate reporting in this space. So if you look at financial reporting, as we all know, it's very clear, right, that there are two dominant standard setters in the world, the IFRS Foundation and FASB in the US. They are very similar to one another. In a sense, they share a conceptual framework. They have many standards in common. There's not a lot of variation. They're also highly consistent with other national standards around the world, very well developed, strong sort of audit infrastructure and all the rest of it. In contrast, the non-financial reporting space, or the sustainability reporting space, or whatever you want to call it, is all over the place. It's non-mandatory. There are a number of different organizations that purport to set standards, or at least provide frameworks. It's not clear how they relate one to the other. Meanwhile, there are some legislative steps coming into place, in particular within Europe right now. But currently, European legislation basically says the law is you must do sustainability reporting. It doesn't say how you're supposed to do it or what it is. It just says you must do it. So it's a sort of, I describe that as mandatory voluntary, right? So you've got to do it, but it's up to you how you do it. So it's basically voluntary. Meanwhile, something like TCFD, the Task Force on Climate-Related Financial Disclosure, is gaining a lot of ground. It's increasingly being mooted as something that should be made mandatory in multiple economies, but it's also pretty vague. You know, it basically says, talk a bit about governance and what you think your risks are, and how you think your business might be affected in the entirely hypothetical and uncertain situation in which the world might warm to 2 degrees, and what might happen to your business. You know, so it's very, very vague. And overall, the space requires, I think, some clarification. So that's what I'm going to try and have a go at doing it at some level. It's important, I think, to start by describing what sustainability is, you know, how I think about sustainability and how I would frame this overall debate. And I think critically, sustainability is not just, I mean, the Sustainable Development Goals, in a sense, are the broadest statement of what sustainability is. Sustainability is not just environmental conservation, environmental sustainability. If you look across the Sustainable Development Goals, it's a combination of economic, environmental and social objectives for society as a whole. The underlying concept of sustainability is one of the current generation not overliving at the expense of future generations, and of creating a society, moving in a direction of creating a society, which is one in which we would all want to live. Very broad, very vague, but nevertheless very clearly economic as well as social, as well as environmental. Okay, translate that to a corporate setting, and the word sustainability, I think, has 2 quite distinct meanings. If you look at the left-hand side of this table, sustainability refers to financial sustainability. It refers to things we would traditionally in the literature think of as being earnings persistence or earnings quality or something. You know, it's the sustainability of financial performance. Ultimately, if a corporation is not able to sustain its financial performance, can't sustain its financial capital, then it will cease to exist as a corporation, right? So financial sustainability is a necessary condition for any other form of sustainability, right? So that's not all that sustainability is about as a concept, but I think it's absolutely critical in the corporate setting to understand that financial sustainability is a bedrock. Across the top here, I've got 3 different types of impact on stakeholders other than shareholders. So, and the way to characterize this, the way the paper that's the backdrop to this presentation, the way it's written is in the context of environmental sustainability, which is actually much easier to think about and conceptualize than social sustainability. So the focus here is if the activities of the company have a positive or negative impact on the environment or natural capital. Natural capital, by the way, you know, synonymous with financial capital. The idea of natural capital is it's the resources of nature. And synonymous with financial capital, you can think of financial capital as being a stock of capital or as a flow of income, which is equivalent to that stock of capital. Likewise, natural capital you can think about as the stock of natural resources, water, atmosphere, whatever it happens to be. And you can think about it as the flow of ecosystem services from that natural capital. So it's directly analogous. And you can think about the maintenance of natural capital in the same way conceptually that you would think about the maintenance of financial capital. So in this table, the box which is positive stakeholder impact and positive shareholder impact, that's when you have a positive impact on both financial capital and natural capital. That's the sort of win-win situation. And what I've described here is a sustainable business. The box below, the philanthropic box, is where you have a positive impact on natural capital, but a negative impact on financial capital. Ultimately, that's not sustainable from a corporate point of view. Go right to the other side. If you have a negative impact on natural capital and a negative impact on financial capital, it's in nobody's interest to be in that business. So coal is the obvious example of that. I mean, obviously, there is still plenty of coal and some of it profitable still, but ultimately coal is a terminally ill industry. It's not an ongoing profitable industry, and it's not one that has an ongoing that has any possibility of an ongoing positive impact on natural capital. Then you have, I think, an important category here, which I've called conflicted, which is where the organization has a negative impact on natural capital, and there does not as yet exist the technology whereby that is avoidable. So it's an inherently profitable business. Airlines are an inherently profitable business, sort of, much of the time, in principle anyway. But there is no way in principle currently and in the foreseeable future that business can operate profitably while avoiding a negative impact on natural capital. The most interesting category is here, the transitional, I'm not sure if you can see the mouse, but the transitional category in the middle, which is businesses where there is currently a negative impact on natural capital, but the potential for positive. I've listed auto as one. So if you think about, stretching in a bit, but if you think about, making electric cars rather than making diesel cars, for example. So there's a business model transition that switches you to to reducing negative stakeholder impact. And in the category below that, subsidizable, there you've got industries, think about solar energy, for example, where the growth of solar panels required subsidy in the first place. The economics have become much more viable. So it sort of moved up towards being shareholder positive and more natural capital positive as well. So the point here is that sustainability has two dimensions. A genuinely sustainable business is one which is financially sustainable and sustainable measured against the benchmark of natural capital. Okay, so that's how I think about it. So that's what I think sustainability is in some sense from a corporate perspective. Now, here's an illustration of why it matters in some sense. I've got a couple of slides like this. This one is a slide which illustrates global carbon emissions, greenhouse gas emissions, over the past 100 years in the blue, and what the emissions need to be over the next few decades in order to meet Paris climate targets. Now, if you were to plot economic growth over the past 100 years, it would look much like this blue line. If you were to plot environmental degradation, it would look much like that blue line, right? So we've seen economic growth going hand in hand with an unsustainable depletion of natural capital, is the bottom line. What needs to happen for the world economy to meet the Paris targets, and thereby for the world economy to be sustainable? And by the way, if it fails, then the economic costs are far greater than if it succeeds. Then what needs to happen is a dramatic U-turn in business models. Notice in business models. So this is an economic argument, right? It ought to be self-evident that if the global economy as a whole does not develop in a manner that is sustainable, there will be negative economic consequences. So it is good for the economy of society as a whole that there is sustainable development. And this is what needs to happen for that to be possible. So again, for the corporate sector as a whole, what we're looking at here is in economic self-interest, we're looking at a dramatic change in the way in which business is conducted. That's greenhouse gas emissions. Here's another example. This is land use. So the rate of land use in particular for agriculture is the loss of land, the loss of biodiversity for agriculture is proceeding at an alarming rate, as you probably know. This plot is showing you the efficiency of food production, essentially. It's saying in order to have 1,000 calories of food, how much land do you need? And what you see is the extraordinary inefficiency of red meat and dairy as a source of nutrition. If you were to plot CO2 emissions, you'd get much the same picture. So the green, actually methane mostly, but the greenhouse gas emissions associated with those sectors is huge in relation to other sources of nutrition. Again, the point here is that this is not sustainable. So this has to change. So in much the same way that to meet Paris agreements, the energy use must change, so too land use must change quite dramatically. And that has obvious implications for the economic viability of agriculture and all related business, whether that's McDonald's or whether that's food retail or whether that's dining. We're talking big sectors of the economy. So sustainability is not a tangential, nice to have, some people like to hug trees kind of activity. It is fundamentally a core, the biggest in many sense, core economic challenge that we have as a society. Now in this regard, I think there's two thought processes that we pick up from economics that are unhelpful. The first is the notion of externality, and the second is the notion of valuation. And the notion of an externality, we all grow up with sort of learning a bit of economics 101, and an externality means that the company imposes a cost on society and it doesn't bear that cost itself, essentially. So, and surely environmental impact is an externality. And surely if environmental impact is an externality, then sustainability reporting is not related to economics. That's kind of underlying the SEC position that I just described. Now, in a sense, nothing could be further from the truth here. That the fact that the global corporate community is imposing significant environmental impact means that global corporate economic activity as a whole is unsustainable. That has economic consequences, right? So the fact that an oil and gas company can avoid its externality in its currently measured financial profit does not mean that the corporate sector, and therefore the capital markets, can avoid the consequence of externality for the value of economic capital, enterprise value as a whole. So the notion of an externality in many ways, although very helpful, in some ways also instinctively leads a lot of us, I think, to think wrongly in this space. Second thing that's unhelpful is valuation. The sort of externalities have long been the domain of environmental economists, and economists don't think like accountants. Economists put DCF valuations on things. Accountants, financial accountants, actively avoid doing that because DCF valuations, again to go back to the SEC comment, are inherently unreliable. They're projections into the future. Accounting, by design, is a relatively reliable record of what has happened in the past. So I think it's common to find the notion of monetizing externalities or introducing externalities into accounting being associated with a need for the application of financial economics. That I think is unhelpful. And so more of the accountants thinking is what is needed in sustainability reporting. If we think more in terms of accountants, actually you get back to the SEC comments, you get to a position which challenges the presumption that sustainability reporting is inherently flaky. Both of those things remind me of the famous John Maynard Keynes comment, which you may or may not have seen. This is the beginning of the general theory. Practical people, actually he said practical men, but I've updated it, who believe themselves to be quite exempt from any intellectual influence are usually the slaves of some defunct economist. In other words, we have these sort of economic ideas that we learn at an early age and never really challenge them. And we're influenced by them without realizing it. So I think that's really important here. Okay, let me illustrate this with 3 different corporate mission statements. The first one is from Saudi Aramco. So these are all from the oil and gas sector, a very obvious sector to pick on in this context. Saudi Aramco says, look, we're focused on a preeminent position in oil and gas, basically. We're an oil and gas company, that's how we make our money. Sure, yeah, there's lots of externalities imposed on society from that, but that's not acknowledged. And that's a kind of, in some sense, a traditional position for an oil and gas company. Second type of business, ExxonMobil, what they're saying is, well, basically we're in an oil and gas chemical business. We recognize that we need to operate responsibly. We recognize that there are some challenges associated with externalities in our business. But when it comes down to it, our job is to provide energy and to provide chemicals. So we'll be mindful, we'll try to be a bit more energy efficient in how we extract oil and gas, but basically that's what we do. Type 3, and this is a recent dramatic change of mindset. So from BP used to be just like Exxon, previously just like Aramco. BP now says, and it's up to you whether you believe them or not, right? That their purpose is reimagining energy. We want to help the world reach net zero. Okay, now on the face of it, that doesn't make any sense at all. 99% of BP's business is oil and gas. So what they're saying is our mission is to stop being the business that we are and become a completely different business, making money in a completely different way. Now, let's be clear, they're not saying that because they care about sustainability as an end in itself. They're not saying that because sustainability is separate from economics. They're doing the opposite. They're saying, if the world is to achieve net zero, then we will not be in business if we carry on being what we are now. And therefore, it is in our economic self-interest that we radically transform this business. Now, notice, none of that you will see in BP's financial statements, because their financial statements do exclude externalities, and they do report very large profit margins and very large cash flows from oil and gas. So there is no indication from their financial reporting that would lead you to this mission statement, right? So, but this is the direction of travel of the business. So the domain of sustainability reporting, as I see it, from a corporate point of view, from a capital market point of view, is reconciling that mission statement of BP with their historical financial statements. This is the paper that I'm drawing upon, which Mohammed, I can make available. It's and I'll put it. It's not yet on SSRN because I'm revising it, but I'll do that. The idea of the paper is basically, how do you develop normatively? How do you develop, or how do you think about a system of accounting which reports financial profit for the benefit of shareholders, investors, and that reports environmental impact from a broader stakeholder perspective? How do you reconcile those perspectives within a single set of information? And this for me, this is the kind of the critical diagram. So let me try and take you through this and explain how I'm using the terminology here and how it relates to developments in sustainability reporting. So box 1 here is financial accounting as we know it. So this is, whether it's IFRS or US GAAP, this is the financial statements and the notes to the financial statements. Now, notice I've used the term financial accounting, not financial reporting. Those two terms get conflated in practice. We think of them as essentially being the same thing. But accounting is a very specific type of information. Accounting is historical, it's measurable, it's verifiable, it's auditable, it's prudent, and all the rest of it. Reporting, I would characterize as being much broader than that. So disclosures that a company makes, its MD&A or more broadly in its corporate reporting, are a part of corporate reporting, but they're not in the financial statements. And so notice the notion of financial materiality is not the same thing as what is material to a set of financial statements. So there is materiality viewed through the lens of recognition criteria and the measurement requirements in accounting standards. And there's financial materiality viewed through the lens of useful information to investors. So most obviously, information about the future that does not qualify for recognition in the financial statements is financially material if it's relevant to enterprise value, but it's not financially material for the financial statements. So in the context of sustainability reporting, this box, number 2 here, is the gap between what goes into the financial accounts and what is financially material in the determination of enterprise value with respect to natural capital. So, for example, much of the TCFD reporting is in that space. The TCFD requirements will say things like, what are your disclose and talk about your material, physical and transition risks associated with climate change. Now, that's prospective disclosure, forward-looking disclosure. It's not in the accounts. It's disclosure that relates to the impact of climate change. If you're BP, it's incredibly important to your shareholders in determining the enterprise value of your business, but it's not financial accounting information. Now, I've summarized all that as being box 1 and box 2 put together as financial reporting. And the use of language here is it's financial, not in the sense that it's monetary, it's financial in the sense that you are reporting to your providers of finance. So the adjective financial, to contrast it with management accounting, the adjective financial is the audience. It's material, it's financially material. It's the audience's investors. It's information relevant to decision making for investors. That's financial reporting. So there is much sustainability reporting which is financial. It's not in that sense non-financial. Moreover, there's a great deal of that information which indeed is measurable, verifiable, and objective. So a company's carbon footprint, which is something that also the TCFD calls for, is decidedly measurable and objective and verifiable. There's a well-established protocol, the Greenhouse Gas Protocol, for measuring a carbon footprint. In many places, it's a mandatory requirement. Carbon is commensurable in the same way that dollars are, right? So a ton of carbon emitted by any business anywhere in any activity can be added to any other ton of carbon anywhere on the planet, right? So carbon disclosure it's like accounting for labor costs or something. It's every bit as verifiable as accounting information. Now, it does raise different questions from accounting information, from financial accounting information, because the boundary of control differs. So in financial reporting, you are only by design in IFRS and US GAAP reporting on assets and liabilities within the control of the entity. Whereas for sustainability related financial disclosure, you're also reporting what's termed scope 3. You're also reporting the carbon footprint of your supply chain. Maybe also the carbon footprint that is downstream, that's associated with the use of your product by your customers. Why are you reporting that? Because it's value relevant to investors. Because your investors need to understand, do you have an economically sustainable business model? And the extent to which you have a negative impact on natural capital suggests that you don't. If you don't have an economically viable business model, what are you doing about it? That's part of the engagement between companies and their investors. It's absolutely relevant to capital markets. It's absolutely relevant to economic decision making. And it's absolutely not in the financial accounts. The financial accounts, generally speaking, don't do a good job here. Because even though you can say, look, in principle, if you have an asset and your asset will become stranded because you're not going to be able to use it anymore because of tightening environmental legislation or something, then you'll have an asset impairment. And if you face environmental litigation or other such things, then you'll have a liability. So, surely the accounts do a reasonable job here. The answer is, I think they don't do a good job because the transition that we expect, the sort of the meeting of the Paris climate targets and so on, is not happening tomorrow or next year. It's happening over a period of decades. So if you have a coal-fired power plant, you can carry on operating that and still meet your climate commitment to be net zero by 2040. it's not impaired. If you have a legal requirement to be net zero, let's say by 2040, then the obligation is to be net zero by 2040, not now. So generally speaking, accounting provisioning doesn't capture eventualities like that. Your sustainability related financial disclosure should. Okay, so notice something here. Most of the development in frameworks and guidance around sustainability reporting are in box 2. TCFD, SASB is explicitly concerned with financial materiality as defined by the SEC. Integrated reporting is also in box 2. CDP is around providing information on capital markets to investors and so on. So most sustainability reporting guidance in practice is in box 2, and that's a source of confusion because it gets challenged and criticized for not being all about societal concerns for environmental and social impact. It's only concerned with how does this affect investors. So if you have ongoing externalities, if investors genuinely don't pay the cost of environmental impact, that information doesn't belong in box 2. This is capital market oriented disclosure. But critically, investors are not the only stakeholders in society, and box 2 is not all there is to say about sustainability reporting. It's a subset of sustainability reporting. It's sustainability reporting that is relevant to investors in making economic decisions about enterprise value. Box 2 is where the IFRS Foundation is in principle seeking to operate.
Question from,
yeah, Karan, yeah.
A question from Serena. You can open your mic and ask your question.
Yeah, thank you, Mohammed. Hi, Richard. Nice to meet you here. So
Hello,
I'm a PhD student from the other place, Cambridge. So yeah, so
Cambridge, Massachusetts, I hope.
Still in the same country. So it's quite interesting to see this diagram. So I just have a question that for the accounting term here, it seems that it only refers to the external side, the financial accounting to external shareholders. And it seems that common that nowadays when we talk about sustainability accounting, we seem to only refer to external reporting. I'm just wondering about the managerial side, the internal side. Do you consider that as an important factor to enter this diagram as well?
So I am just talking about the external reporting. Of course, they are very closely related. What you would expect is the management accounting information to be ahead of the curve, right? So you would expect a company with a large environmental footprint to have a great deal more information internally than it discloses externally, because it's not required to disclose externally, but it's in shareholders' interest that the company understands the extent to which its business model is exposed. So I don't think there's no conflict conceptually going on here, but I think there's a conflict in practice between how much information is financial and how much is management.
Okay, great, thank you.
Thanks for the question. So box 2 here, this is where the IFRS Foundation is, at least in the first instance, proposing to act. The IFRS Foundation has a mandate to provide financially material information. Box 2 is where it currently fails to provide that information. So the conceptual framework of the IFRS Foundation, it's very interesting. Basically, it says, our job is to provide useful information to investors. And then it says, here's how you do financial accounting. What it doesn't do is say, our job is to provide useful information to investors, which means that our job is to do financial accounting and our job is to do sustainability related financial disclosure. So again, this is the conflation of financial accounting and financial reporting, I think. That this space of disclosure that supplements the financial accounts that is useful to investors in capital markets is massively underdeveloped. So what the IFRS Foundation is doing in substance is recognizing that deficiency in its reporting, in its mandate. Now, it also makes a somewhat confusing and unhelpful claim that once it's sorted out reporting to investors, it will also do reporting to stakeholders other than investors. I think that's a confused statement, and the challenge from the SEC that I described at the beginning is valid in that regard. I think it was inappropriate for the IFRS Foundation to go beyond its mandate to provide information to investors. I can say more about that, but that's where it should be focusing, is exclusively in box 2. Okay, so that's the first two boxes. Box 3 is accounting for current externalities. So carbon is the obvious and easiest example. If box 1 measures financial profit, then box 3 measures the financial cost of the externalities imposed on others. Box 1 plus box 3 is a measure of the inclusive profit that a company makes. So if a company makes a profit in box 1 of 100, let's say, and its investors benefit by 100, but in doing that, it imposes environmental costs of 30, then society as a whole is better off by 70. So that's what box 1 plus 3 is in principle measuring. Now, this then raises the question of how do you do the externality accounting? What does that number mean? How do you measure it? There's quite a bit on this in the paper. Basically, the idea is that what you shouldn't do is go down the financial economist's route of trying to value externalities. Instead, what you should do is go down an accountant's route, which would be to say, what is the current replacement cost of the damage that's been done to the environment? So we emitted a certain amount of carbon. What would it have cost for the organization not to have emitted that carbon? That is an historical, measurable cost to the entity, not a subjective, unverifiable impact on stakeholders that are not the entity, right? So it's a method of measurement which is consistent with accounting principles of measurability and reliability and so on, and also consistent with reporting for the entity and not reporting for stakeholders of the entity. Now, in the case of carbon emissions, that's a relatively straightforward thing to measure. It's more difficult to measure with some other aspects of natural capital, more difficult still for social capital. But in principle, I think that's what that metric ought to be. Notice it's not the cost of, as it were, the cost of having a non-negative impact on natural capital, which is what that means, is a hypothetical cost. So everything in box 1 is an actual cost incurred by the entity because it's in the accounts, right? That's what you're doing. You're accounting for incurred costs and revenues and so on. If it's an externality, by definition, you haven't incurred the cost. So what box 3 is saying is, if you had to pay to internalize the externality, what would it cost? And so the bottom line is, what would your profit be if you had a non-negative impact on natural capital? Now, remember how I defined sustainability right at the beginning. Sustainability is concerned with, you're a sustainable company if you have a non-negative impact on financial capital and a non-negative impact on natural capital. That's a measure of that. That your financial accounting number is your change in financial capital, your externality number is your change in natural capital. Notice something else as well. There's an emphasis here on negative externalities, not positive. One of the invitations of financial economics is to allow companies to make up calculations of positive externalities, especially in the context of social capital. We spent 10 million on staff training, and add a multiplier to that, we created 25 million of social value or something like that. Completely spurious number that would never make it into a set of financial accounts. What this is doing is saying, you have objectively, verifiably emitted a certain amount of carbon, and it would cost you a certain amount to make good that amount. So it's a much more conservative and verifiable method of accounting. It also addresses directly the problem that society is concerned with. The problem society is concerned with is negative impact on natural capital. if corporations had a positive impact on natural capital, we would not be having this conversation now, right? So the long-term sustainability question, as it were, the context for all of this is economic activity, corporate economic activity being inherently unsustainable. In other words, impact on natural capital being negative. Okay, so the final box here, box 4, is the bit that completes the set. So the relationship between 1 and 2 is the same, is analogous to the relationship between 3 and 4. Box 1 is historical, verifiable, measurable. Box 2 is other information that's relevant to investors in determining enterprise value. Box 3 is historical, verifiable, and so on from a societal perspective. Box 4 is other information that's relevant from a societal perspective. So the adjective non-financial is used here, the sum of box 3 and 4 is used to refer to information that's not relevant to investors. Notice that's incremental to financial reporting. So the baseline is financial reporting. The non-financial reporting is incremental information that's not provided to investors. It's useful to other stakeholders in society, but not useful to investors. If there's an overlap, if information is useful to both, then it's in financial reporting. And again, this is the way that the IFRS Foundation is thinking, that it's trying to establish a global baseline for sustainability reporting. Critically, it becomes a question of actually governmental responsibility to set standards for non-financial reporting. So if there are standards for capital markets, but there are additional costs imposed on society that investors are not concerned with, suppose for the sake of argument that biodiversity impact is something which investors have not yet figured out how to factor into enterprise value, and they're not too concerned about it. But from a societal point of view, it really matters for long-term sustainability. In that situation, it's a governmental responsibility to require standards for biodiversity impact. And in a sense, governments are avoiding their responsibility by assuming that the IFRS Foundation will take care of that responsibility. Notice something else. The box 3, the externality accounting box, is empty currently in substance. Box 4 is sort of GRI at some level, but box 3 is empty. There are no standards in that space, and there's almost no corporate practice in that space. But box 3, I think, is absolutely critical. I mean, imagine if you had, for all companies globally, a measure not just of their financial profit, but of their, as it were, all-inclusive profit for society. That metric would be massively enabling of change in business models towards being more sustainable. It would have a massive influence, I think, on the corporate, on the social license to operate the corporations have. So box 3 is, I think, massively overlooked in the literature and in practice. The research literature has some stuff on box 3 that's quite old now and very little in recent years, in substance. I'm exaggerating to make the point. And then the final thing here, the bottom right, all these boxes together are sustainability reporting, in my view. So go back to the SDGs. The SDGs are economic, social, and environmental. Financial accounting is a subset of reporting to investors. Financial accounting and sustainability related financial disclosure is all reporting to investors. It's all economic. And then you add to that societal impact and you get to comprehensive reporting relating to SDGs. Okay, so that slide is the kind of, that's where all the argument comes together. But as you can see, there's quite a lot of relevant thoughts that relate to each of those different boxes.
Richard,
sorry. Yeah.
Can I ask a further question on that diagram? So 2 questions. First, how do you consider SASB, so Sustainability Accounting Standards Board, their standards fit in this diagram? And second question, there's recently some development work from Harvard for the impact accounting.
Yeah.
So do you consider that as a good attempt for box 3 actually?
Right. So SASB is box 2. And notice, the language of dependency and impact is important here. So The box 2 is asking the question, how is my business affected by natural capital? How does that affect enterprise value? In other words, in what way does my business, depend upon natural resources? So if you're BP, the ongoing ability to generate economic value depends upon the rate of climate change. Right? Box 3 is about impact. Box 3 is about what damage am I doing as a business? So imagine you've got an airline which, in terms of its sort of social license to operate, customers will keep buying tickets, and governments are not imposing CO2 taxation at any sort of sensible level. And so it's an economically viable business model. Box 3 on here would have a big negative externality. And box 2 would say, actually, the prospects of climate change are not having that much of an impact on our business just yet, but we're keeping an eye on it. Right. So SASB, TSD, TCFD, integrated reporting are all box 2. So it's an investor-oriented capital market perspective on sustainability. It's a financial capital model of sustainability.
Right, but how about the impact-weighted accounts?
The impact-weighted accounts conflates valuation with accounting. Right, so it's using valuation coefficients as accounting metrics, rather than using accounting metrics as accounting metrics, in my view. Does that make sense?
Yeah, thank you.
Richard, can I ask a question too? So it seems like we also are leaving out the subsidies that governments give to companies. So in the form of, governments that provide defense to protect borders, to protect even, places where companies operate around the world. And there's no measure of what corporations benefit from the government is.
Yeah.
So those government subsidies are not measured.
So in principle, you would say box 2 and or box 4 should include disclosures of that type. So again, notice the level of government subsidy to, and it tends to be environmentally damaging companies that get subsidized, right? So government subsidy to the dairy industry, to the beef industry, to the oil and gas industry, and so on. Those things, the question is not, are they verifiable and measurable? They're very easily verifiable and measurable, right? They are accounting metrics in that sense, right?
Mm-hmm.
Are they box 2 or box 4? Well, it depends whether you think investors care about them or not. If investors are sufficiently worried that subsidies will be withdrawn from the oil and gas industry, then it's absolutely box 2.
Can I ask you too?
I don't think that, then it's box 4, right? In principle.
Right. You made a statement that governments are responsible for the sustainability part and investors for what's important to them. But governments regulate markets, and they regulate the financial reporting. It's not investors that get together and demand that. It's the government's job, and its accountability, at least in the US.
Yes.
It was designed to protect the public, not to protect investors only.
But the function of the SEC is explicitly concerned with capital markets and nothing else.
But it was formed to protect the public interest, not the capital markets.
But it's formed to protect capital markets in the public interest, right? That's different from protecting the public interest in general. So there was as you're probably familiar, an important test case of this was conflict mineral disclosure in the US. Mm-hmm. That was forced through as an SEC requirement, but actually it was a public policy disclosure. It wasn't investors care about this information disclosure, and therefore it was incredibly contentious. So actually it was a box 4 disclosure masquerading as a box 2 disclosure.
So they violated their own intent, really.
Yes, and that's why it was so contentious, yeah. But that doesn't mean it wasn't appropriate for governments to require that type of reporting. It's just the SEC is not the vehicle for it.
Okay, at least in the US.
In the US. Internationally, the IFRS Foundation is private. It's not a government-controlled entity. as it happens.
Okay, thank you.
Hi, Richard. Can I have one more question?
Far away.
Sure, thank you. So I totally agree with you that box 3 is extremely important, especially nowadays, like with the current ESG rating, we saw that sometimes there are the mismatch between good
That's box 3, by
performer.
the way. That's what it would look like in practice. But yeah, go ahead.
Okay, yeah. There are the match, especially when you do like ESG investing. But for box 3, I would like to know, are there any possibility or are there some real life attempts in doing that?
Almost none. And that's part of what I'm trying to draw attention to.
Mm-hmm.
Puma, and which is now Kering, is a kind of famous example of a company that sort of did this and then stopped doing it, and now say they do it but don't really. And so again, you'd find this thing much more commonly, to go back to the earlier question, as an illustration of management accounting. So internally, you'd expect companies to be aware of this, or they ought to be if they're not, right? But not as a matter of external reporting. If you think about it, there's not much incentive to report this externally, right? Your sustainable profit will be a smaller number. It's like reporting economic value added. It will be a smaller number than your financial profit, right? And it's not mandatory, and nobody else is doing it. So why would you, right? So companies don't in practice. And because all the attention around sustainability reporting is focused on box 2, there isn't a focus on box 3, right?
Yeah,
so in a sense, the attention, paradoxically, the increasing attention to sustainability reporting is taking attention away from reporting environmental impact.
Mm-hmm. One more question. Since we also said just now that company wouldn't be the owner of, for example, box 3, then who potentially can be like the owner for box 3? Like who will be pushing it, or who it's possible to take the responsibility of?
It's a very good question. So let me just very briefly, just some references here. The first 2 papers those papers are all about the inherent limitations of accounting in relation to valuation. So much of the general thinking that I've been describing to you. The third one here is a very short HBR piece on the institutional structure of sustainability reporting and how that's evolving. I think the answer to your question is a good illustration of the answer to your question is the European Union right now. So I think in the ideal world, you would have the IFRS Foundation setting global baseline sustainability reporting standards on things where there is investor consensus globally, right? So you would have climate reporting being an IFRS Foundation question. Then the EU would, in addition, incremental to that, within the EU, say, actually, we also want companies to report on whatever, gender equality, or whatever the sort of policy issue is that's of importance within the democratic mandate of the EU. And you may notice these things will vary by jurisdiction, right? So things that are, in particular in the social capital space, things that are important within the democratic mandate of different governments will vary in different parts of the world. Actually, it's true in the environmental space as well. You'd like to think that reporting on environmental impact, deforestation in Brazil would be more prominent as a matter of social importance than in Iceland or something, right? So you would expect there to be variation in that space, but I think it's a question of governmental reporting above the global baseline, basically.
Richard, hi, this is Rahul. Just had a comment that, sort of traditionally companies were allowed to function because they provided a social, they had a social function, and that's a reason, in fact, why sort of Companies House exists and stuff like that. So I see no reason why the government can't say that, forget the SEC, let's look at the social value of the organization.
And by the way, it's important that the enterprise value bit, although the focus is financially material for investors, of course, to a very large degree, corporate economic activity promotes the sustainable development goals. It creates decent work and education and economic growth and all these good things. It's only when there's also externalities that the government needs to step in.
But I had a question around aggregation. So, what happens in the oil industry very commonly is that the extractor is capturing some of the rent, so there's rent seeking. So which is basically the capital of the society, which is then treated as income in the books of the oil extractor. And income has a different propensity to consume compared to capital. And if you think about mental accounting, sort of, if you treat it as a windfall, you spend almost all of it. If it's income, it's maybe 30-35% is saved. And if it's large inheritances, all of it gets saved. So your capital remains capital. So even if rent, how do you deal with this issue where in aggregate, sort of you might do all the accounting, but in aggregate, the society still is consuming some of its capital and therefore unsustainable.
Yeah. So you know more about this topic than just about anybody, by the way. So yeah, it's a dangerous question to try and answer. But there's two problems with that, right? One is if natural resources, given by nature, sort of minerals and whatever else, are never on anybody's balance sheet in the first place, as it were, but the income from selling them is, then you're measuring income in financial accounting while you're not accounting for the depletion of natural capital. That's problem number one. Problem number two is that if those resources are non-renewable, then not only are you counting income in the sense you shouldn't be counting, but you're not going to be able to carry on counting it because you're going to run out, right? So, so it is a fundamentally flawed system. Notice, the introduction of the corporate sector, right? The introduction of the notion of rights and obligations of corporations and so on, post-dates the gift of those assets to society in some sense, right? So this is very much unlike assets acquired by a company and that's sitting on its balance sheet. These are the institutions of the economy are not well designed to cope with that problem, essentially.
Can I ask a question, Richard? This is Amama Shaukat from Brunel University, London. Hello.
Hi.
Hi. If you could please, you mentioned your sustainability statement, yeah, in which you talked about the costing of externalities, and you were saying that historical costs are verifiable, they are measurable, but I think the problem with using, say, if you were to think of using historical cost as a way of, as the counterfactual, the company has incurred the cost, it has created an externality. And if we were to say, what if it was not an externality? And if we look at it as a historical cost, whatever it's not yet clear how we do it, but that would assume that because historical cost is, even in financial accounting, we say it's a bit outdated concept because it assumes that the environment is not changing. Other variables that affect costs are constant, which are not.
Yeah.
While the company is polluting the environment, other companies are polluting it at the same time. So it's not just that the company's own impact on the environment matters. It's a multitude of factors that affect the cost simultaneously.
So I've massively glossed over the complexity of measurement, right?
Absolutely.
One of an open question here is, do you, as you would for a provision, for a sort of decommissioning or something, do you remeasure? So it would be one thing to say, what would the cost be now of offsetting environmental impact? It would be another thing to keep a record of that, all right, and to revise what it would cost over time. So take carbon offset, right? If picture sort of the marginal cost curve for offsetting, it's going to be the first offsets you do are going to be cheaper than the ones you do in future years. Technology, whatever, taken as given, right? So the longer you leave it before you offset, in some sense, the bigger that hypothetical liability should become. I think that gets a bit complicated and a bit too hypothetical and a bit unrealistic. I think the main point of doing the calculation, as I see it, is to make a statement at a point in time of the extent to which the business's value creation model is not sustainable. And so that's the information that triggers public awareness, investor awareness, social license to operate change, which I think ultimately is the thing that changes the economics of the business that causes the change. I think that's more important than updating the accounting measurement.
Well, this is a provocative question to follow from that. The fact that the environment keeps changing and the variables that affect costs keep changing. And there is inflation, of course, and there are other factors, financial factors, which will affect costs as well. So it's a very tenuous concept. So maybe would it not be a good idea for perhaps to measure natural resource-related costs in natural resource-related terms? I don't know.
Okay, you notice something very important here, which I didn't mention. There is the object of the financial measurement of the externality is grounded in the physical maintenance of the natural capital, right? So what you're doing is saying natural capital matters as an end in itself. Mm-hmm. And what you're measuring is not how much are people affected economically by the depletion of natural capital. That would be an environmental economist's approach. What you're saying is, what would it cost financially to restore the damage that's been done to natural capital, right? So at heart, it's an ecologically sensitive approach. It's not a financialization approach. It's making the ecological commensurable with the financial, but doing it subject to the physical maintenance of natural capital. So maintaining the ecosystem services, essentially.
Okay, that's what I was, yeah. Thank you.
That's an important point. We're up on time. I don't want to keep people, but I'm more than happy to carry on discussing. So Mohammed, it's your call really, how you want to handle
it. Peter?
You mean you want me to ask my question? You know, I really don't want to prolong this, but Richard, I think your paper does a tremendous job, and your talk this morning has done a tremendous job in encouraging people to take ESG, CSR, sustainability accounting very seriously as part of their research agenda. And it's only just now that that's starting to happen. So what you've given us is a presentation at something I'll call 30,000 feet. But I know you have thoughts about the importance of this at a day-to-day level and getting it into people's agenda. I'd encourage you to just say a few words, you know, even though we're out of time.
Yeah, for me, I think the single most important message is one of there being a business case for sustainability. So if you go back to the notion of sustainability in a financial capital sense, and also you think about the economic logic of the corporation in a capitalist system, it can only operate around financial capital and returns to investors. That's the way competitive markets work. And so critically, one has to think about the sustainability agenda through that lens of making a business case, which is why, to come back to the beginning, why I couldn't disagree more with the SEC statement that the economic and the sustainable are separate. Another way of saying that is that in aggregate, there's a positive NPV to sustainability, right? You know, the global economy not being sustainable is just not a smart idea for economics, basically.
Dear Prof, the last question from Henry Friedman.
Thanks, and sorry to prolong this any further, but it seems like a key issue with taking sustainability issues into accounting, at least in some settings, is the notion of measuring opportunity costs and translating those into monetary amounts. So in particular, when you mentioned this notion of what would it have costed to avoid doing some damage in your response to the previous question and during the talk. And I was just wondering if there's other precedents in accounting that are maybe obvious that I'm missing, where accountants are tasked with measuring opportunity costs, because that seems like something that's very difficult to do reliably. It'd be hard to audit. It'd be hard to estimate. There isn't necessarily like an underlying cash.
Yeah,
it's different from forecasts, right?
Yeah, it's
from
not,
projections.
It's not measuring opportunity cost. It's measuring replacement cost, right? So it's not measuring the economic loss from something foregone. It's saying what would it cost you to replace. Now, I
guess maybe saying counterfactual, like putting a dollar value on counterfactuals is maybe a better way to phrase it. So sorry for that.
Yes. And there is an unfortunate accounting history in this context, which is when there was high inflation back in the 70s and 80s and so on, and accounting standards assessors developed inflation accounting standards. Replacement cost was a big deal at that time. And one of the reasons why it kind of faded, it was not just that inflation fell away, it was that it's actually a pretty difficult thing to do to measure replacement costs. Right? It raises both conceptual and practical issues. I think those are unavoidable.
Thank you.
Thank you very much, dear Professor Richard, for your
contribution and your effort. Sorry, just one more thought before I finish. A more current example, actually thinking about it, is level 3 fair value. So which financial reporting standard assessors have pushed quite strongly. That's very similar, right? What it's doing is saying a level 1 would be there's a market price. Fine, that's measurable and objective and whatever else. Level 2 is there's sort of a market price, right? You can approximate it. Level 3 is saying, what would the market price be if there was a market, right? That, which is absolutely accepted in financial reporting and by the SEC and whatever else, is very much in the same space. In fact, in a sense, is more of a counterfactual, right? Because it's saying, imagine a market. There isn't one, but imagine one. Whereas this is saying, don't imagine how much impact you've had on the climate. You can see it. But so what would it cost you to offset the carbon is less subjective than a level 3 fair value measure, actually.
Thank you very much. Thank you very much, dear Professor Richard, for your contribution and your effort. It's really an excellent presentation. Thank you very much. And that's all that remains for me, as I say, to say thank you everyone that joined us, and I thank you very much for taking the time out to present to us today, dear Professor Richard Parker. It's been really appreciated. Thank you very much.
Thank you. Thank you very much for inviting me.
You are very welcome. And I hope to see you soon in Egypt.
Yeah, let's hope so. Yeah. Very good. Bye-bye.
Bye. Nice to meet you. Thank you.